How do you know if real estate investing is for you? In today's episode of Dental to Rental, we're going to cover the three most important elements of determining whether investing in real estate to build wealth is the right strategy for you. Hey, welcome back to the Dental to Rental podcast. I'm your host, Mark Brower. So excited to welcome you to our first full episode. We're going to cover the three areas that I think are the most important to evaluate to know if this is the right asset class for you to build wealth in. There's a lot of different ways to build wealth. Real estate, spoiler alert, real estate investing is not for everybody, in my opinion. How do you know if it's right for you? These three areas, by the end of this podcast, I'm hoping give you more confidence and clarity around whether you should try to build wealth through real estate. And I'm a huge believer. I've owned rental properties for 20 years, as I mentioned in the last episode. And I'm a firm believer that if done right, wealth building can happen at a much faster rate with real estate than it can in other traditional investing vehicles. But it's not for everybody. So getting right into it, segment number one, risk tolerance. What's your risk tolerance? Are you okay sometimes having things go wrong? Are you willing to take on a little bit higher risk for higher reward? I knew from a very early age, I'm an entrepreneur, so no surprise, I have a very high risk tolerance. I'm okay if things are blowing up on me. Occasionally, if I can see through the trees, I can see the forest, and at the end of the forest, there's a pot of gold, and I'm going to get there eventually. I'm okay waiting through some times when I'm down or I'm going sideways or things aren't great. My wife and I started buying rental properties in 2002, and so we suffered through several years post 2007, 2008, when we were underwater on everything we owned. We didn't capitulate. We didn't sell. We hung in there. Super glad that we did because it's worked out. So check in with yourself. What's your risk tolerance? If you can't be down some of the time, if you can't have a few bumps along the way, don't get into it. There's also things that we'll cover in future episodes, like getting the right mortgages and doing other things to minimize your risk. But I wouldn't call this a super low risk investment strategy like government bonds or T-bills. Number two, emotional honesty and tolerance. Okay, this is the one that almost, in my experience, nobody talks about this. I recently read a book that totally shaped my mindset, gave me a paradigm shift about this aspect of investing. And it is the ingredient of the emotional tolerance that we could have for a certain investment strategy. This came from the book, The Psychology of Wealth. If you haven't heard of it, if you haven't read it, go get a copy, buy it on Audible, listen to it. It's a fantastic resource. In fact, I got this because a really smart networking group called Hampton of tech company founders, really smart people, it was put out in their newsletter that this was the number one book by far recommended among their members for wealth advice and wealth building investment advice. Psychology of Money, in a nutshell, my takeaway is there's a lot of different ways to build wealth, and the compounding effect of building wealth over time is the single most important predictor of success. In other words, finding a winning strategy and staying with it for a very long time is what makes the difference. In fact, they even cited an example where this guy won a Nobel Prize for a new portfolio allocation strategy. It was groundbreaking. It was like the modern way of investing money. And he was interviewed after writing that book or after writing those research papers, and he was asked how he invests his own money. And he revealed that he doesn't follow his own groundbreaking strategies because he doesn't trust that he'll have the emotional stability, the emotional stick-to-itiveness to stay in when the market drops. Because it's really hard. Like when your investment portfolio is down 50, 60%, most people freak out. They can't handle that and they make an irrational choice. Warren Buffett, widely recognized as the most successful investor of all time, has achieved 22% average annual returns over the last 7 decades, but he's not the most successful return investor of all time. There's a hedge fund manager since the 1980s, this is discussed in the book, that has achieved over 60% return on investment. Nobody talks about this guy, at least not as much as they talk about Warren Buffett. Why? Because his overall returns is not as much as Warren Buffett's. Warren Buffett's made like 90% of his net worth after turning 55, and that's after he'd been investing for 30 years. So the gains that you make 3 and 4 decades from now are massive compared to the ones you make in the beginning. We know the compounding effect. Einstein or somebody said that the 8th wonder of the world is the compounding effect of compound interest, right? So pick a strategy that you can stay with for a long time, that you have the emotional tolerance for, and real estate might not be that strategy. Why? Because what if you get hit with roof repairs, AC repairs, and you have an eviction in the same year in the same property? Are you going to be able to stay in that asset? These things don't happen very often, but occasionally, if you stay in the asset class long enough, you build a 3 to 5 property portfolio, you're going to get hit with all these in the same year. Are you going to wash out? The biggest tragedy I see, the biggest roadblock for people staying in this asset class and really giving it enough time to build wealth, is they get washed out because of the stress. It happened to my father. It happened to my brother. Fortunately, for some reason, I just stayed in it for a long, long time. And now it's been a massive benefit to me. So that emotional honesty and emotional tolerance for this asset class is the most important ingredient. Number 3, financial readiness. Don't get into this asset class before you're financially ready. What does that mean? 2 elements. Number 1, have a strong income. And number 2, have some cash reserves. Well, Ed, don't do what I did. I got into this asset class when I was 22 years old, full-time college student, working full-time cleaning pools, servicing pool chemicals rather. And my buddy was a full-time college student and working full-time. We were paycheck to paycheck, literally. And we bought a house together. We house hacked, moved a bunch of guys in. It ended up working out. But in hindsight, that was way too risky. I can't believe I did that. Fortunately, the AC didn't break. I didn't have any major plumbing repair issues. There's a lot of things that could have gone wrong with the older house that I invested in that just didn't. I got lucky. My recommendation is have a strong income, have at least $1,000 to $2,000 a month, at least discretionary income left over that you don't really need for your lifestyle needs. Have that buffer in place on a recurring basis, and then have at least $10,000, my opinion, $10,000 in reserve per rental property. Or once you get a portfolio of 3 to 5 properties, have at least $20,000 that you can tap into at any one time for your portfolio of rental properties, so that when you do have the unexpected AC issue, you have the unexpected vacancy, you have the roof issue, etc., it's not a major setback for you. So that's it. Risk tolerance, emotional honesty and tolerance, and financial readiness. These 3 things, look at them straight in the face, have a really clear, honest conversation with yourself. If you can check these 3 boxes, the upside potential in investing in real estate is huge. My journey was, I started with that first property in college. Unfortunately, I lost money on that property. It was an older property. The market was flat. I didn't know what I was doing. I was managing a bunch of individual roommates, renting different rooms on different leases. It was kind of a disaster. And I didn't see it getting any better anytime soon. Fortunately, when I met my wife, she had already been under contract to buy a new build house. So much smarter. She paid more money for that house. On paper, the return on investment percentage number was lower, but what it did is it put us in a strong position where everything was under builder warranty. We had very little repair costs for the first 5 years. We were able to attract and retain high quality residents, get strong rents. It was a really stable asset. So we did ourselves a favor that we didn't even know we were doing, and we bought in a new community so that it gave us that emotional stability that we could tolerate. And that helped us, even though we didn't have strong income. Eventually, as our income grew, we were able to put more money down, larger down payments, have more of a cash flow buffer on the additional assets that we bought, and things got even smoother, more predictable, and less risky as time went on. Okay, so now that we covered those three things, I just want to tell a cautionary tale. The cautionary tale is someone I'm really close to. I won't call him out by name, but somebody I'm really close to started buying rental properties in 2004, 2005, and there were a lot of people buying rental properties at that time. Unfortunately, a lot of people with the wrong mindset, right? So they went into this and real estate prices were going up so rapidly, it just seemed like if you just bought houses, you were going to win the lottery. I remember being at a new home community and they were drawing lotteries for who would be able to buy the next home. And there was a crowd of people standing on the street around the new home sales center. And if your name got drawn, people were erupting with cheers and applause. It was nuts. It was not sustainable. Someone very close to me bought 18 rental properties during that time. It was very easy to get loans. It didn't matter if there was cash flow positive, and ultimately lost almost every single one of them in a short sale or a foreclosure in the next 5 years. Don't do that. Be smart. Understand that this is a 10 to 20 to 30 year investment asset class. Go into it with a very long-term mindset. Go into it with a fixed interest rate mortgage. Go into it with the right strategic partners. By the way, all of these things I'm mentioning, the right debt, the right strategic partners, the right asset type, these are the topics we're going to dive into in greater detail in the upcoming episodes. So definitely stay tuned. This is Mark Brower, your host of Dental to Rental, where I want to help dentists unlock the financial freedom and the time freedom by building wealth through real estate. Be sure you subscribe so you don't miss any episodes, and we'll see you again really soon.